Welcome to Stock Market Today, your pre-market briefing delivering actionable insights on stocks, bonds, crypto, and the macro events that will move markets this session. Let's cut straight to what matters for your trading day. 10 days ago, President Trump lobbed a grenade into the financial sector. At Davos on January 21st, 2026, he announced support for legislation capping credit card interest rates at 10% for 1 year. According to Consumer Finance Monitor, this isn't speculation anymore. It's a live policy proposal with massive implications for how you position in financials today. Here's the setup. Current credit card rates sit above 20% on average. NerdWallet data confirms most consumer cards are charging north of 20% right now. Trump's proposal cuts that in half overnight. This isn't incremental regulatory tweaking. This is a sledgehammer to the credit card business model. Let's talk immediate market impact. The big money center banks derive significant revenue from credit card interest. We're talking about JP Morgan Chase, Bank of America, Citigroup, Capital One, Discover. These names have credit card portfolios generating billions in net interest income annually. A 10% cap slashes that revenue stream dramatically. Chase CEO Jamie Dimon already signaled the fallout. According to reporting from Ambrune Analytics, Dimon stated small businesses will lose their backup credit if this cap passes. That's bank speak for we're pulling credit lines to manage risk. When rates get capped below the cost of capital plus risk premium, banks restrict access. Basic economics. If you can't price for risk, you don't extend credit. Bank of America is already moving. NBC News reported Bank of America is considering launching a new credit card, capped at 10% interest. They're front-running the regulation. That's defensive positioning. They see this proposal gaining traction, and they're getting ahead of potential legislative momentum. Here's what traders need to understand about the regulatory framework. Credit cards currently operate under state usury laws and Federal Truth in Lending Act requirements. The Federal Reserve sets monetary policy that influences baseline rates. The Consumer Financial Protection Bureau provides oversight, but there's no federal interest rate cap on credit cards. States vary wildly. Some have caps, most don't. A federal 10% cap would override all of that. Federal Reserve data from Fred, their economic database, tracks commercial bank credit card interest rates. The series shows rates have remained elevated, even as the Fed adjusted policy rates. That spread between the Fed funds rate and credit card rates represents the profit margin banks defend aggressively. Cut that margin, and you cut bank earnings. Let's break down the legislative landscape. This isn't Trump's original idea. According to Congress.gov, Senate Bill 381, in the 119th Congress, proposes similar interest rate cap legislation. Bernie Sanders has championed 10% credit card caps for years. Alexandria Ocasio-Cortez has backed similar measures. Trump adopting this populist stance puts bipartisan pressure on the proposal. That's the real risk for bank stocks. If progressives and Trump both push this, the political math changes. The American Bankers Association already released opposition research. According to their issue backgrounder on credit card interest rate caps, the industry argues caps reduce credit availability, particularly for subprime borrowers. They claim caps hurt the very consumers they're designed to protect by limiting access to credit. That's the lobbying line. Whether it holds up politically is another question. Now, let's talk trading implications. If this cap passes or gains serious legislative momentum, here's your playbook. Bank stocks with heavy credit card exposure face multiple compression. Analysts will slash earnings estimates. You'll see downgrades across the sector. Capital One and Discover are particularly exposed. Their business models lean heavily on credit card portfolios. Those are your high-risk names in a rate cap scenario. Diversified banks like JP Morgan and Bank of America have more cushion. They generate revenue across investment banking, wealth management, commercial lending, and mortgages. Credit cards are a piece, not the whole pie. Still, it's a meaningful piece. Expect sell-side analysts to model out the revenue impact. Watch for guidance cuts on quarterly calls. On the flip side, this opens opportunities. Community banks with limited credit card exposure become relative winners. If the big banks pull back on consumer lending, community banks and credit unions gain market share in other lending categories. That's a potential rotation play. Alternative lenders also benefit. Fintech companies operating outside traditional banking charters might structure products differently. Buy now, pay later platforms could see increased demand if credit card availability contracts. Look at Affirm, Klarna's public comps, and other installment lending plays. Regulatory arbitrage creates winners and losers. Consumer discretionary stocks face mixed signals. If consumers lose access to credit cards, spending power decreases. That's a headwind for retail, travel, and leisure sectors. But if lower interest rates apply to existing balances, consumers have more disposable income. The net effect depends on implementation details we don't have yet. Let's address the macro picture. A one-year cap is temporary. Markets hate uncertainty, but they adapt to defined timelines. If this passes with a one-year sunset clause, banks will manage through it. They'll tighten underwriting, reduce credit limits, and shift marketing to fee-based products. The long-term business model survives, but that one-year window creates earnings volatility, and volatility creates trading opportunities. Bond markets are watching this too. Bank debt and preferred equity will reprice based on earnings risk. If credit card revenue drops, coverage ratios on bank debt decline. Credit spreads widen. That's a tradable move in bank-subordinated debt and preferred shares. High-yield bond traders are already modeling scenarios. Crypto angle. Some argue restrictive credit regulations push consumers toward decentralized finance. If traditional credit becomes harder to access, do people turn to crypto-backed lending? It's speculative, but worth monitoring. Bitcoin and Ethereum don't move on this news directly, but DeFi tokens could see narrative-driven interest if credit access tightens. Here's the timing risk. We're 10 days past the Davos announcement. No legislative text has been introduced specifically from Trump's proposal. Senate Bill 381 exists, but it hasn't moved. Watch for House or Senate sponsors to introduce new legislation citing Trump's support. That's your catalyst moment. When legislative text drops, bank stocks will react. Lobbying efforts are ramping up. The financial services industry has massive resources to fight this. Expect coordinated campaigns arguing economic harm. They'll produce studies showing reduced credit access hurts low-income consumers. They'll highlight small business impacts. They'll threaten job cuts. This is a full-court press defense. Political dynamics matter. Trump backing a progressive policy creates strange bedfellows. Does the Republican establishment support this? Or do they break with Trump to protect bank donors? Democratic progressives will push this hard. But moderate Democrats from financial industry states might resist. The Senate math is tight. Watch vote counts. Consumer advocacy groups are mobilizing support. They'll argue 20% interest rates are predatory. They'll highlight credit card debt statistics. Over $1 trillion in outstanding credit card debt in the U.S. economy. Average household credit card debt runs several $1,000s. Interest payments represent a significant burden. That's the populist argument for the cap. Constitutional questions linger. Does Congress have authority to cap interest rates under the Commerce Clause? Legal challenges are likely if this passes. Banks will sue. Expect injunctions and stays while litigation proceeds. That uncertainty keeps a lid on how aggressively markets reprice bank stocks in the near term. For active traders, volatility is the opportunity. Whether this passes or fails, the debate creates price swings. Trade the range. Use option strategies to capture volatility without directional bets. Straddles and strangles on bank stocks could pay off as headlines move prices. Bottom line for today's session. Financial sector faces regulatory overhang from Trump's 10% credit card cap proposal. Banks with heavy credit card exposure are at risk. Diversified banks have more resilience. Alternative lenders and community banks could benefit. Legislative progress is the catalyst to watch. No immediate market-moving developments overnight. But this remains a slow-burn story with explosive potential. Position accordingly. If you're long financials, assess your credit card exposure. Consider trimming concentrated positions in Capital One and Discover. Add hedges if you're staying long. If you're looking for opportunities, watch for oversold bounces when lobbying efforts gain traction. This proposal faces an uphill battle, but the volatility is real. That's your market intel for today. Now get out there and trade smart. For more real-time insights, check out capitalcopilot.io